Hi everyone, welcome to today's webinar. So for today's webinar, as you can see, we are looking at stop loss strategy for today. So we're going to go through a couple of different types of stop loss strategies through our slides, and then we'll go through some setups as well after we've gone through these slides. So throughout the webinar, if you have any questions, feel free to let me know in the chat. And let me know if there are any specific setups you'd like me to go through as well. Okay, I think without further ado, we can go ahead and get right into it. Okay, just want to check to make sure you can see my screen and can hear me clearly. Okay, seems like everything is good. Okay, let's go ahead and get started. So before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so maybe just a brief introduction. I am Melanie and I will be your speaker for today's stop loss strategy webinar. Okay, let's go ahead and get started. So here's our agenda for today. Firstly, we'll talk about how stop loss will affect your risk to reward ratio beyond and before. So if you're wondering what that is, we'll get into that in a little bit. And then how far should your stop loss be, market structure stop loss, Fibonacci stop loss, and then we'll go through a couple of trailing stop loss strategies as well. Okay, but first things first, we'll go through the anatomy of a trade as well as some risk management strategies. So trade management refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. So, of course, the anatomy of a trade contains or consists of the entry, your stop loss orders, as well as your stop profit or take profit orders. And then this is what is part of a risk management series, which we won't go through in detail today. Maybe in future webinars, we'll go through these. But for today, we're going to focus purely on stop loss, and we'll touch a little bit on trailing stop loss as well. Okay, so firstly, why is it so important to have a trade management strategy? So firstly is to control risk. Trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses as well as manage their overall risk exposure. Next, maximize profits. So trade management strategies such as take profit orders and trailing stops help traders to lock in your profits and maximize returns. Manage emotions. This is pretty important because the discipline and structure that having a good risk management strategy provides can help traders to stay calm and rational even in volatile markets. which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So when you have a well-defined trade management plan, then you can make faster and more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly, increase consistency. So an effective trade management strategy and risk management techniques helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so let's get into it. So although we're focusing purely on stop losses for today, I do want to touch a little bit on take profit as well. So we'll start off by going through the issue of having a fixed take profit and stop loss. Okay, so we're going to start off with take profit. So let's take a look at this example together. So the red area here shows a strong resistance area because this has two multiple swing highs that line up nicely. So if our trading strategy requires us to have a fixed take profit of 100 pips, then we will place the target beyond this strong resistance area, which you can see here. That's what we did here. Okay, so let's see how this plays out. And you can see that price shot up, but it missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So it might not reach where you place your take profit. Okay, so here we see in an alternative scenario, if we had placed our take profit before the key resistance level, which means just slightly below, we would have got a profitable trade because price would have been nicely touching our take profit. So it's important to look at the charts and then adjust your take profit and stop loss accordingly. So the lesson that we're trying to talk about in this case is to not blindly follow a fixed take profit target just because some forum or education platform tells you to do so. Because you always want to look at your charts and adjust accordingly because each chart is different. Okay, so this is the general idea for stop loss and take profit placement. So this is what we meant earlier by beyond and before. So for a stop loss, we would typically recommend you to place it beyond a major resistance area. So if we're talking about a major support area, or this should be support instead of resistance. So if we're talking about a major support area or even a major confluence area using Fibonacci, you want to place your stop loss below it or beyond it. Below would be if it is a support level. And you can see in this case, since it's a resistance area, we'll place it above. So that's what we mean by beyond. So for our take profit, on the other hand, we want to make sure that we place it before. So that means that it's within the charts. So not beyond it, before it. And if we're talking about a major resistance area, then we will want our take profit to be placed just beneath it. Okay, so this is the general idea for a proper stop loss and take profit placement to ensure that you maximize your wins as well as minimize your losses. Okay, we'll go through a couple more examples in the next few slides as well. Okay, sorry about the mess over here, but this is just to recap a little bit about the whole stop loss beyond take profit before concept, but in the context of Fibonacci confluence. So in this case, we're talking about Fib confluence. So stop loss beyond still stays, and you want to place it beyond a key Fibonacci confluence area. So price is attracted to strong areas of Fibonacci confluence. And if your stop loss is right before, instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the most common reasons why people wonder why they got stopped out right when the market starts to reverse. So if we talk about take profit, we mentioned earlier we place it before a key Fibonacci confluence area or major resistance area, so on and so forth. And the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So this is one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so that's the general idea of trade management and where is the proper placement for stop loss as well as your take profit levels. Okay. Here in this case, we are talking about the problem with fixed stop loss. So earlier we talked about the problem with fixed take profit. So now we're talking about stop loss. So here's an example to show this problem. Here we have a support level. You can see two swing lows that line up nicely at this support level. Price has bounced off of this support level, and we are expecting it to continue to rise to the swing high resistance over here at the 1931.43. Okay, so our stop loss of 100 pips is fixed at this 1894.75 level at the support level. Okay, so this is what happens instead. Instead of shooting up as we expected it to, it actually reversed off of our entry and then bounced off perfectly. So what we should have done instead was to place our stop loss, which was over here, the green line. Instead of the green line, we should have placed it at the yellow line instead, because we mentioned earlier that you want to place your stop loss slightly beyond a key level of support or resistance, just to allow that space for a reversal or a bounce to take place. Okay, and we can expect this to happen because price often gets attracted to key levels of support or resistance and then reverses off of them. Okay, so now we're going to talk a bit about dynamic stop loss placement. So that's what we talked about in the previous few slides, is precisely why dynamic stop loss placement is so important. So if you're wondering what exactly is a dynamic stop loss, it's a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. So the goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. So here is our first example. It's to demonstrate dynamic stop loss. Here we have price bouncing nicely off of the support level at 86.721. So it's bouncing off here. We're expecting it to reverse off the entry at this 87.819. That's in line with this 100% Fibonacci projection level. Okay, and then our stop loss is placed at this swing high resistance here. So this is what happens. We're expecting it to reverse off. So it does test this level, this entry level. And the reason for this, for that bit of resistance, extra resistance at the entry, is because you can see earlier we have this 100% Fibonacci projection that lines up nicely with this level. So you can see the resistance and price testing this entry. Next, we have the negative 27.2% Fibonacci expansion, as well as the 61.8 Fibonacci projection that line up nicely. So this is where we decided to place our stop loss. And this is how we use Fibonacci levels as stop losses as well. When you have a couple of levels that line up nicely, we call that a confluence area. And it's even better if you can find a chart indicator or market structure indicator, where basically you look at the chart and you see that, oh, this is a resistance level, and we place a stop loss here. And this stop loss lines up nicely with Fibonacci levels as well, which makes it extra important to take note of. So we see price is testing the 87.819 level at the entry here. So we mentioned earlier that stop loss should be placed beyond the Fibonacci confluence area instead of directly on the area. And we'll show you why in the next slide. So this is a zoomed out version of what we had in the previous slide, but you can see price breaks out of our entry and it hits right towards our stop loss levels. And it's just as we had expected, because this is, as we mentioned earlier, that this area is an important area with the Fibonacci confluence as well as the swing high resistance. So this whole area is a strong area, and its price is attracted to such strong areas of resistance. So we can expect price to be attracted to this area. So what we do is we place our stop loss beyond it. And you can see if I place my stop loss directly on this Fibonacci area instead of beyond it, we would have gotten stopped out. So we're expecting the reversal, and it hits right down to our take profit, which is exactly what it did here. Okay, let me know in the chat if there are any questions throughout the webinar. But I think so far we should be pretty clear on this. So let's take a look at another example. In this case, we have another take profit placement example. So here we're expecting price to bounce off of our entry at the 87.625 level at the pullback. So this is what we call a pullback resistance, because we have a swing low here and price has passed this area here. So before price actually reverses off this area, it's called a pullback, because we are expecting price to pull back to that level or retrace to that level. Okay, so our stop loss is placed at the swing high resistance here, and our take profit is placed at the swing low resistance. And then if we take a look at our Fibonacci, we have the 78.6% Fibonacci retracement that lines up nicely with our entry level. So once again, this is a level for us to take note of. We can expect price to be attracted to this level here. Okay, you can see price moving up this area. Price hit our entry and has reversed off of it nicely. It's now heading towards our take profit. And then we pull out another Fibonacci indicator. In this case, we are using Fibonacci retracement. Okay, this is wrong. It should be 50 Fibonacci projection, because this is our starting point, our middle point, and our ending point. So this is a 78.6% Fibonacci projection. Sorry about that. But the chart is still correct. We have a projection level that lines up nicely with our take profit. So you can see we're expecting price to be attracted to this area because of the swing low resistance, swing low support, as well as this Fibonacci level. So you can see price was attracted to this area. It approached it continued downwards to our take profit, and it touched our take profit just nicely before reversing off of it. So this is one reason why we advise you to place your take profit before it, because if you had placed it even slightly below, you would not have caught this take profit there. Okay, actually even this take profit level is a little bit far, so you have placed it further in on our price chart. Okay, next example, we're looking at a take profit placement again. So even though this is stop loss, but we want to talk about take profit to show you guys how the two line up nicely together. Because even if you have mastered all of the stop loss strategies, if you can't manage to get your trade in a take profit, there's no point to it basically. So here we have firstly a descending trend line, but you can see our price has recently broken out of this descending trend line. So it's giving us a bullish bias. Okay, so after we've established that, we go in with our take profit and stop loss levels, and these we make use of the support and resistance levels here. So our entry is at this pretty significant level, overlap resistance. Overlap just basically means that a bunch of swing lows also line up nicely with a bunch of swing highs, and price has tested this level many times. Then our stop loss level is just at the swing low here, and our take profit is in line with many Fibonacci levels that you can see here. So it's a negative 27.2% Fibonacci expansion, as well as 127.2% Fibonacci extension. So with these two lining up at our take profit level, remember you want to place your take profit before instead of beyond your Fibonacci levels. Okay, in this case, you see we placed it above or before it, or beyond it, I mean. And you can see price reversed off of it and we missed our take profit by a few pips. So if we had placed it below instead, it would have nicely hit our take profit before reversing back down to our entry. Okay, so now let's get into the trailing stop loss. So a trailing stop loss is a special type of trade order that moves relative to price fluctuations. So when the price goes up, it will drag the trailing stop loss along with it, but when the price stops going up, the stop loss price remains at the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as long as the trade moves favorably. So an automatic trailing stop loss moves according to how price moves favorably, and then a manual trailing stop loss is a moving stop loss level that's based on mechanical indicators. So here's an example of where you place an idea invalidation level. Okay, so here's our first level. This is moving average. Here we have the Chandelier SAR. Here with the ATR is parabolic ATR as well. Okay, so here is how to use them. Okay, in this case, we are using moving average as our first example. So here we are going in for a sell entry. You can see I've indicated this level where we want to enter from is a 1.57891 level. Okay, and this is where price crosses the moving average indicator, and that's my entry. Also note this ascending trend line as well, and price is breaking out of it. So a lot of bearish indicators over here. Okay, so price, or rather we call this a moving average crossover. So once price crosses over price, then we go in for the entry. Price continues moving downwards, and then once price is once price crosses over the moving average again, then our trailing stop loss is triggered. Okay? So it got us out before this happened. So this is the before, this is where you get stopped out. And then this is what happens if you weren't stopped out. Okay? Here we have trendline trailing stop loss. Remember, for a valid trendline, you need at least 3 touches for it to be valid. Here we have 1, 2, 3 over here. Okay, so the same concept on the same chart, we have this trend line with price moving downwards, and once price starts reversing, even though it's reversing, we are not stopped out yet until it hits the trend line, and then we are stopped out. Once again, to prevent us from this eventual upward movement. Okay, so here we have parabolic SAR, trailing stop loss. It's the same concept. We are going in for a sell entry once price changes, or rather once our indicator changes. So it's moving downwards, and then once price hits our parabolic SAR indicator, that's a sign for us to be stopped out. So yeah, that's how the parabolic SAR trailing stop loss works. Okay. Here we have Chandelier and ATR trailing stop loss. So it's all on the same chart, just to show you guys how you can use the different indicators as your trading stop loss, just to help you guys decide when to stop or get out of the trade. So same thing, same sell entry, same chart. So we go in for the sell over here. Once price moves downwards and it hits our indicator once again, then both of these indicators are triggered and you have gotten out of the trade. So it really minimizes your losses that could have resulted if you had allowed price to continue moving upwards. Okay. So here, how we know this is our sell entry, using these two indicators. Basically, when price overlaps over here, as you can see over here, there's another overlap that takes place, and that's why you get stopped out. Okay. So here is an actual example. Here we have the Kiwi dollar, and we are making use of the moving average indicator. So we go in for the sell entry over here when price okay, firstly we have this ascending trend line. So it's moving upwards, and then we go in for a sell entry once price starts moving down. So it hits this ascending trend line as our sign that it's gonna break out of the ascending trend line. Going for the sell entry, we continue, and it hits our take profit. Okay, another indicator is that over here, at this green line that I've indicated here, you can see price cross over our indicator. So that's yet another sign that price is gonna continue downwards, or trend is going to change. Okay. Next example, we have once again a trend line. So trend line going upwards, price breaking out of it, then we go in for our sell entry. So going for our sell entry all the way, we're expecting it to move all the way downwards to our take profit. Okay, so the red and the blue lines, as you can see here, the lines that are not indicated as stop loss, sell entry, and take profit, these are the lines that we are showing you are pretty significant because we have an overlap resistance here. So as I mentioned earlier, an overlap is a swing high and a swing low that line up in the same level. So that's our red line. So remember I mentioned that when we have significant areas of resistance that we want to place our stop loss beyond it. So that's exactly what we did here. And then as for our take profit, over here I have a big swing low over here. So which is why I place my take profit before it instead of below it over here. Okay. So that's the end of our slides. Now we're going to look at some charts and see if we can implement what we've just learned into actual setups. So let me know in the chats if there are any specific setups that you'd like to see. I think, yeah, I think you should be able to let me know in the chat or let me know in the Q&A section. Yeah. Okay, I think in the meantime, let's go ahead and just take a look at maybe euro dollar. Okay, if there is any other commodity or currency pair you'd like to see, feel free to let me know in the chat. Okay, so let's get right into it. So we typically like to start on the higher time frames and then work our way down. So here I have on the weekly time frame, we have a pretty bullish, I mean, it looks like price is moving upwards, the general direction. Okay, on our daily as well, we have a ascending trend line. Okay. So both weekly and daily time frames are giving us pretty bullish trends. Now let's take a look at our 4-hour time frame. Okay, it does look like price is breaking out of the ascending trend line here. Okay, but let's go in with some support and resistance levels. So here's my first resistance, and then my second resistance over here. My first support just here. And my second support here. Okay. So now that we have that, let's go in with our Fibonacci levels. So from here to here, I have a retracement. You can see my 50% retracement lines up, and my okay, even though this 50% lines up nicely with my first resistance, it's no longer valid because you can see price has already broken out of this level. So I'm going to look at the other levels. For retracement, we use these 5 levels: 23.6, 30.2, 50%, 61.8, and 70.6. Okay, and I can see that my 78.6 lines up nicely with my second support. So I'll just keep that. Okay, now let's go in with a Fibonacci projection. Okay, I can see that my 61.8 and my 100% line up nicely. Okay, I think that's all the levels that I have. So now I'm going to go in with some indicators. So the indicators that we like to use are Ichimoku and MACD, because just at one glance, it tells you exactly what the signals are. So price is moving below the Ichimoku cloud on our indicator, giving us a bearish signal. MACD is giving us a pretty bullish signal. Slightly bullish over here. Let's take a look at RSI. Okay, we have this bullish signal. If we take a look at our chart, at our price chart versus our RSI, at the highlighted areas, price has remained at the same level at our first support, whereas on our RSI, it has made a higher high, and in fact, price is moving in this ascending trend line on our RSI. Okay, so I'm gonna go ahead and remove this trend line here, because earlier I mentioned that it could be breaking out of the descending trend line, right? But it also could be an ascending trend line. So this is one of those rare occasions where we have 3 touches on the trend line for both, depending on how you adjust it. Okay, so that's why I waited for all of my other indicators as well as my analysis to be completed before I go in and adjust my trend line. Okay, I'm going to remove my Ichimoku as well because it doesn't support our analysis. So you can see that we have quite a lot of bullish pressure here. So we can expect price. Let me just highlight this area as well. Okay, here. So my first support I mentioned is a pretty significant level with all of the swing highs and swing lows and price testing it many times. But I also have the 61.8 Fibonacci retracement and a 61.8 and let me take a look. Yeah, 61.8 Fibonacci projection. You can see this 3 points over there. So my 61.8 Fibonacci projection lines up nicely with my first support. So I can expect price to reverse off of our first support and within this ascending trend line. Okay, let me know if you guys have any other questions. Okay, if not, I think we can move on to our next chart. Let's go ahead and take a look at gold. Okay, so let's begin by looking at the higher time frames again. We have these three swing highs. Price looks like it's moving upwards here. On our daily time frame, price is pretty bullish as well. Okay, this is not a valid trend line, but I think we can all agree price's general trend is upwards. Next, 4 hours time frame. Okay, I have this trend line. Now let's go in with our support and resistance levels. Okay, so I have a support level here. Next, I have a resistance level here. But I'm not going to label this as my first resistance. I'm just going to call it an intermediate resistance because it's really close to where price is at currently. So I just want to keep that in mind. Okay, no. Okay, I try to pull it back as far as I can, but I'm cutting too many candlesticks over here. Okay, next, our second resistance here. Okay. So now let's go in with our Fibonacci levels again. So same thing for a retracement. I use these 5 levels. Okay, and I can see my 38.2 lines up and my 78.6 as well. So I'm just going to keep those two. Okay, next I'm going in with a Fibonacci projection. So for Fibonacci projection, we use these 3 levels, 100, 78.6, and 61.8. And okay, my 78.6 lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Yeah, I think that's about it. Okay, now let's go in with some indicators again. So price is moving below the Ichimoku cloud. It's also giving us bearish on our MACD. Now let's take a look at RSI. Okay, once again, we have a pretty bullish divergence again. Okay, now let me take a look at stochastic as well. Okay, I'm gonna go ahead and remove our ascending trend line. Okay, here we have a descending trend line, and on our stochastic, we also have a descending trend line here. Okay, so I'm gonna move my RSI, and 3 out of the 4 indicators that we've used tell us that it is a descending or it's a bearish momentum. Okay, so in this case, I can expect price to continue moving upwards towards this intermediate resistance, but there will be some resistance over here because of all of the downward pressure from the indicators as well as the descending trend line and also this 38.2 Fibonacci retracement. And as I mentioned earlier, this is a pullback area, pullback resistance. So I can expect price to have some resistance here and maybe reverse off of it and head back towards our first support. Okay. So in this case, our take profit would then be at our first support, entry at our intermediate resistance, and then I'll place my first resistance as my stop loss. And as I mentioned earlier, I want to place it above, maybe slightly above over here, because this area here is a pretty big resistance area with all of the Fibonacci levels lining up nicely. Okay, I think I have time for one more chart. So if you guys have any requests, feel free to let me know. Okay, let's go ahead and take a look at DXY. Just really quickly, this will be our last one for the day. Okay, so same thing, let's take a look at the weekly time frame. Looks like price is moving downwards on our daily as well. Okay, it's moving in this descending trend line on our daily time frame. Okay, nope, trend line on our 4-hour time frame. So let's just go ahead and add some support and resistance levels. Okay, and then here is my first support. And my second support here. Okay, now let's go in with our Fibonacci levels. Okay, my 78.6 lines up. And let's go in with a projection. Okay, for projection, we use these three levels. So I'm just going to check. Okay, and price has surpassed our 61.8, so this is no longer valid even though it lines up with our first support, but our 100% lines up with our first resistance. So I'll be keeping that as well. Okay, so this is a significant area for us to take note of. Okay, I think that's it. So let's take a look at our indicators. Price is moving above the Ichimoku cloud. It's also giving us bullish on our MACD. Okay, RSI isn't really telling us much here. Okay, no. Okay. Let's maybe take a look at stochastic as well. Okay, stochastic is pretty bullish as well. Okay, so we can expect price to continue upwards and be attracted to our first resistance since there is such a major confluence area here. But we can also maybe expect it to reverse off and hit back down to our first support. So, but as of right now, it will be attracted to the first resistance, but it's not likely to pass such a large resistance area. Okay, that's all I have for you guys today. Let me know if you guys have any other questions. If not, I'll see you guys next week. I hope you guys found it helpful. And yeah, I'll see you guys next week and have a great rest of your week. Bye, guys. Bye. Thank you.